Stock market's closing out the second quarter on a high note, ladies and gentlemen. Here we are. We have seen trading up. Bulls are running on Wall Street. Everything's looking great. We even saw the GDP number come out today. It was revised higher. What can we say? All we can say is the good times are here, but will they last? Welcome, everyone, to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and hot Scottsdale, Arizona.
Really hot Scottsdale.
I know it is
hot.
It's got to be brutally hot, but you are still going to brave the elements and hit the golf course, and that's all that matters. And I know you'll have a probably air-conditioned golf cart as well.
It'll be in the bar, Todd. It'll be in the bar, and it's air-conditioned, all right?
There you go. We are joined by a very special guest, a featured guest, Sam Stovall. He is the Chief Investment Officer over at CFRA Research. Sam is coming back to Buy, Hold, Sell to give us his outlook for the second half of the year. Welcome back to Buy, Hold, Sell, Sam.
Hey, happy to be here, Todd. Good to talk to you again, Tobin.
Yes, and remember, Todd is on his fifth cup of coffee, so just, he'll take it down a little bit.
Is that grounds for concern?
I'll be here all week.
You had to take it. You must have taken a comedy course at Muhlenberg. That's all I think. You always have all the jokes, Sam. So, Sam, one thing that isn't a joke right now, though, is the stock market. We actually had some I guess we would say a bit of a downturn last week. Here we're closing out the quarter on a high note. We had some great numbers that have rolled out at 8:30 this morning on GDP. And now you have to suspect, I know that the market continues to climb this wall of worry, as you have recently stated. But, I mean, is there anything to really worry about these days?
Oh, absolutely. I think first off, history told us that we should have expected a very positive first half, and I can go through those later on if you want. And also history tells us that we should prepare for a good second half, that momentum tends to carry over from one half to another. But since your question is what keeps me up at night, I jokingly say Putin because he snores, but really the answer is that my big worry is a rate wreck, meaning that if the Fed just is hell-bent to raise rates much, much higher than we believe that they need to, then yeah, it's not just to see a crack in the regional bank area, but rather to have a real meaningful break in real estate, in banking, et cetera. So my big worry is that the Fed takes it further than they need to, because right now the Fed funds rate is higher than the wage inflation, than the year-on-year core CPI, PPI, PCE, et cetera. And so I really think that they have gone far enough, or at least with a July hike will have gone far enough.
Okay, Toby, I mean, we've been beating the drum about AI. We've been optimistic this entire quarter. It's clear that big tech is really the rally. I know it's a narrow scope when you're looking at the entire S&P 500, but I just don't see any headwinds. I mean, Sam's talking about if the Fed overshoots, but I don't know. I mean, is it even going to matter? I mean, what do you think?
Well, I think Sam's on the right track, but I just finished a one-day research project, or as they say in Canada, project. And I was really focused on, where we are, reality, where, the Fed has sort of painted this picture that you have to be draconian. And remember, we still have 2 jobs for every 1 person available. Well, we have 2 jobs for every 1 person available, because if you actually look at demographics and net immigration, we only have 1 person for every 2 jobs in the United States. I mean, you can't, if the solution would be to raise rates so high that we would literally destroy 5 million jobs, either, 2 million get fired, another 3 million jobs get taken off it. Well, you're not going to have that. I mean, I spent 30 years in Washington, D.C. If you think the Fed is going to be raising rates into a presidential rate cycle to put the country in a recession, then you have not been around as long as Sam and I have, number one. Number two, my favorite one, John Rutledge, I was saying, our old friend, economist, put something out this week saying that, well, if remember that shelter costs are 46% of all the CPI stuff, right? Rent and mortgage rates, right? And taxes, blah, blah, blah. So it's a huge the CPI, the CPE is 72% services, and shelter is a service, believe it or not, right? So if you just step back for a second and look at when when housing prices and rent started going down, it was October of last year, number one. So when we get to October, we're going to see year over year lower shelter costs, right? Number one. Number two, we understand that now that people have I can get a 3-year, a 5-year, a 30-year mortgage at 7%. Back in the old days, like 16 months ago, I was getting mortgages for 2 or 3%. Those people are not selling their houses, obviously, because what are they, being an idiot? So the only thing that's selling, really, as we saw this week, are new homes. And the reason why the new homes are selling is because the builder takes part of the profit and they, quote unquote, pay down the mortgage. They suppress the rate because they pay it cash to the mortgage lender. Well, guess what? Home building is a huge amount of GDP. And then the third thing you have to look at is, and I think most people really don't understand this in the United States, the top 20% of households own, as of yesterday, 86.5% of all the wealth in the United States. You maybe will understand why people started going Make America Great Again when they realized that the bottom 80% own about 14% of the wealth. And what's happening right now, and I just use anecdotally, I had to fly to LA for business last week. To get a flight, no way. To get a first-class hotel, no way. Friends are trying to go out on Seabourn to go on a great cruise, no way. No, see, the top 20% spending on discretionary items, not stuff, but houses is a huge part of this stuff. When you add that all up together, the math doesn't work. We're not going to have a recession unless the Fed goes, full Paul Volcker. They're not going to go Paul Volcker to 12 or 14% rates going into a presidential year, because guess what? The Fed is just as political as any other freaking person in DC. And so therefore, I think that's what the market's telling us. And I think Sam's absolutely right that given that background, I'd want to own stocks. And then because of the productivity enhancement that's clearly coming from AI, that EPS should grow. And certainly spending is there. So, I mean, that's the case. And the bear case that we're going to just kill the economy holds no, it's all smoke.
But what do you think, though, Sam? I mean, killing the economy, it just seems like that's a far-fetched idea right now. I mean, maybe 6, 9, 12 months ago, we were very worried about this. And here we're at, 500 basis point of rate hikes plus, 500 plus. And it's not impacting the economy at all. If anything, things are actually moving along quite nicely right now. I mean, is the fear of recession really there? Because Wall Street doesn't seem to think it is.
Well, left to its own devices, I don't think there is a fear of recession, but I think the fear is that because we've been getting such good news recently, consumer confidence, durable orders, new home sales, and also the GDP, as Toby just mentioned, all that stuff is good news, driving the stock market, at least in the near term. But then that could cause the Fed to say, well, wait a minute, things are getting out of hand. We've got to take the punch bowl away a second time and raise rates much further than they need to go. So, I mean, right now, Fed funds futures are saying, yeah, we'll have a hike in July, but then that's it. And I think that the market is basically saying, we agree with you. And as a result, knowing that going back to 1989, whenever the Fed stopped raising rates, they started cutting rates 9 months later on average. The S&P was up 13% on average, all sizes, styles, sectors within the U.S. marketplace, combined with 99% of the sub-industries were in positive territory. Can you guess which was the one that was in negative? You're right.
1989? 1989 was savings and loans?
No. Since 89. So gold was the only subsidy that average decline. Everybody else was positive. So a rising tide definitely lifts all boats. And the tide comes in when the market feels that the Fed is done.
Yeah. And Todd, we always say that the market is forward looking. But in this case, it's been hard to look forward through anything because everything's been so idiosyncratic. We never had a pandemic, then a post-pandemic, then a work from home, then a Russian-Ukraine invasion. We've never had all that stuff. And I think it made a lot of sense that people were just confused and everybody's model did not work. I mean,
well, hold on. And you're right. You're right about the models and they're not working. But Sam, Powell came right out and said we're going to have 2 rate hikes left this year. But just with what you just said, are you suspecting that we're actually going to have a rate cut this year?
No, we need at least 9 months before the Fed starts to cut rates.
Okay.
So we're thinking the first cut takes place maybe latter part of the first quarter of 2024. Fed Chair Powell has been saying, the dot plots say that we're going to be adding 2 more rate hikes. Yet he then always ends with, but of course, we're data dependent. And so as the data continue to come in and to show that inflation continues to take, like Duchamp's descending a staircase, we see declines in year-on-year inflation readings, then I have a feeling that the Fed might say, you know what, not only did we pause last time, but we will pause again after the July hike. Okay.
What do you think, Toby?
No, Sam's right. Although I don't know what the Duchamp thing is. That's a little highbrow for, certainly for Todd Schoenberger it is. But I'll go back. I'll just go back to the fact that I think people have a poor grasp that in the United States we have 3,100-ish counties, but 62% of those counties create 72% of our entire GDP. Number one. So I don't, from a macroeconomic standpoint, I don't look at those other freaking counties because they don't matter to the overall state. Number one. Number two, obviously we have an excess right now of oil and natural gas and other energy products. So all of those prices have already told us. If you look at all the commodity prices coming down, geez, that sort of says we're going to have less price inflation. And then the final part is that 14, that small percentage of households that owns 80% of the freaking money in wealth in the United States are spending like crazy because we have the wealth effect, because they're saving freaking $5,000 a month and not commuting. I mean, all the ways that the upper top 20% community. I'm telling you, in North Scottsdale here, if you want to go out on a Friday night, you better have had a reservation for 2 weeks at a decent restaurant, unless you're pulled into Popeyes, which I occasionally do as well. If you look at the affluent parts of America, that's what's holding up the service economy. The product stuff is done, right? The supply chain stuff is done. Now it's back to services. And oh, by the way, healthcare is 18% of the United States economy, and healthcare spending is going like this because of all the procedures that were delayed during the pandemic. So I can give you 58 more things of why the economy is not going south. But
there's definitely healthcare inflation. Absolutely. Sam, before we go to break, I want to ask you this. We had your peer on, your professional peer, Gina Martin Adams from Bloomberg. She was on the show last week, and she came right out and said that she doesn't care about the economy, to the point where she's just simply looking at the equity market, because equities are going to continue to rise no matter what's going to happen, or whatever happens with the economy. They're not correlated, in other words. Do you believe that is the case, or do you think that the economy does or should be incorporated in your analysis a little bit more than, say, Gina is looking at it?
Well, I think that, the economy does help decide whether we're going to see higher or lower corporate profits. But I agree with her that really, if you're trying to figure out the economy, you're putting the cart before the horse. The stock market anticipates recessions by 7 months. It anticipates the end of recessions by 5 months. Actually, the NBER's Business Cycle Dating Committee takes 8 months before they tell us that the speed bump we hit a while back was a recession. Usually by the time they come out and tell us that we're in recession is when you should buy. So essentially, I think that, yes, prices lead fundamentals, and we can talk in the second block why I don't think that valuations have risen too much since the bear market bottom.
Yeah, Todd, I just add the Atlanta GDP now, which is the real-time measurement of, it had 2 negative quarters in 2022, which I think we called out. And people don't sort of believe that numbers, but I know 2 of the guys that have put that together. They were dead right. I mean, dead right. That bear market followed right after those 2 negative quarters of GDP, but it's new data, so the old fogies don't follow it. But boy, they're looking pretty smart right now, Sam.
Yeah, but that's some brilliant analysis by both of you, actually. So listen, let's leave it right there, because coming up in the next block, we're going to follow up with what Sam just was talking about. Really want to get his thoughts on the second half. Plus, maybe we'll talk about a few sectors as well. Maybe some that you should look at, maybe some that you should stay away from. But we are joined today by CFRA's Chief Investment Strategist, Sam Stovall, on Buy, Hold, Sell. Please stick with us. We'll be right back after the break.
Buy, Hold, Sell, brought to you by CrossCheck Management.
In a world where secrets have consequences and lies can't be hidden forever, immerse yourself in the gripping new thriller No Lie Lives Forever by Todd M. Schoenberger. Join Wall Street hedge fund manager Travis Carmichael as he delves deeper into a web of corruption and conspiracy, finding himself entangled in a high-stakes game where souls are at stake, and trust is a luxury he can't afford. Critics and readers can't get enough of this heart-pounding page-turner, calling it a masterfully crafted suspense novel that will leave you breathless. No Lie Lives Forever is a masterfully crafted thriller that will leave you guessing until the very end. With its intricate plot twists and unforgettable characters, this is a must-read for fans of suspense and mystery. From the mind of acclaimed author Todd M. Schoenberger comes a novel that will challenge your perceptions and keep you turning the pages late into the night. Critics and readers alike can't get enough of No Lie Lives Forever. It's been hailed as a gripping roller coaster ride, a true page-turner that will leave you breathless. Don't miss your chance to uncover the truth. Immerse yourself in the suspenseful world of No Lie Lives Forever by Todd M. Schoenberger. Available now on Amazon and at finer bookstores near you.
Welcome back to Buy, Hold, Sell, where the second quarter is coming to a close, but it's on a high note. Will we look back at this time and really miss it because we're going into the second half of the year? Well, our featured guest today is actually quite optimistic and says maybe good times are actually not only here to stay, but we're going to see even better times next quarter. Welcome back, Wolf. So we have Sam Stovall, CFRA's Chief Investment Strategist. I think originally, Sam, when I introduced you, I had you as the Chief Investment Officer, the CIO of CFRA Research. My apologies on mixing up the title there. But either way, you are probably the most important research analyst that CFRA has. I know you don't want to say that on the record, but we could say it for you. So Sam, I do want to talk to you because you're just in your commentary that you had published just recently, you talk about the second half of the year. You seem very optimistic. We've had you on the show a few times. You've always been very positive, but you seem overly positive right now. But are there any pitfalls that investors should be leery of as we go into the second half?
Well, you started the first block with negative news, so let's start with positive news. I like to say that when life gives me lemons, I make whiskey sours. So,
that is so well rehearsed, Stovall. That is so well rehearsed.
All right. Beginning of the year, the market told us it was going to be a good year, or at least chances are. Whenever we've had a down year, the market actually posted a better than expected return, up 14.5% on average versus a 9% annual gain for all years going back to World War II. And we saw an improvement in the batting average, 81% of the time versus 71% of the time that the market was higher. Add to that the Stock Traders Almanac's January barometer, so a down year followed by an up January. The market was higher by 21% and was up 92% of the calendar years. And then if you add, well, if the first quarter low was not below the December low, the market was up 100% of the time in those calendar years. And the average price gain was 25%. I'm not saying that we should expect that kind of return, but I do believe that we have a positive bias in our favor. Going again back to World War II, whenever you have had a positive first half, and that first half saw a gain in excess of 10%. We're up 14.5% through the 29th. The market was up an average of 8%, or basically twice the average second half gain, with the frequency of advance up 13 percentage points. So my year-end target is 45.75, the same target as I introduced in late December of 2022, which is really less than 5% away from where we are today. And I think that we have a lot of things going in our favor. One being that the bear market ended on October 12th of last year. We saw it advance by 20% through June 8th. Plus, we have recovered 70% of what we lost in that prior bear market. We have never had a new bull market turn right around and then break below the prior low. Basically after recovering as much as we have. We tend to go on, recover all that we lost, and then we're in a sense, uncharted territory. But history says we still have a ways to go.
45.75, Toby. What do you think? You gonna top that number?
Yeah, I think so. And there's a couple of things. I mean, obviously, I love the historical references, but remember that it's not always the same. It just rhymes a lot. I was feeling a little TMT deja vu there for a while, Sam, when all of a sudden, anything with AI. My favorite one was C3 AI, which is a POS company that doesn't do any AI, but they just added AI to their number, to their name. When they went up 350%, now I was thinking about .com, days, that mania. Yeah. And it ran so hard and fast, we needed to pull back. We needed just at least come back to the 20-day moving average, right?
Oh, I agree. And, when you think back to 2000, however, everybody was saying, oh my gosh, the stock market is cheap because we're trading at 60 times forward estimates. Right. It's like, technology is not that important, or at least worth that much going forward. But right now we're looking at something that's well less than half of that valuation for the technology sector. Granted, I think one reason why large caps are outperforming small caps, even though they normally outperform, small caps normally outperform large caps in the beginning of a new bull market. First off is because of the cap that the possible higher interest rates represents for this group, but also because the tech sector is 28% of the large cap universe, but less than half of that in small caps. And you have a greater representation in financials and real estate in small caps than you do in large caps.
Yeah, there's no question, Sam. And Todd, when you're asking about downside stuff, well, the one I'm finding very interesting is the office space REIT holders and the office space Fornados and all these big office holders, and they're going to figure it out. Remember, we sort of had our little stare in the face of death with the Silicon Valley Bank failure, and then the fear of the ripple effect. And these guys jumped in with crazy money behind us. They just basically it was too big to fail, even though it wasn't too big to fail, right? But think of the other stuff that's going on now. Is we got about $6.5 trillion of cash money that's been injected into the United States economy with the Semiconductor Act, with my favorite Inflation Reduction Act, malarkey, the greatest name of anything of all time, since it does nothing to reduce inflation. But we haven't even added that $6 trillion of spending. I can tell you here in Arizona, Taiwan Semiconductor is putting a $365 million plant, a $3.65 billion plant, and they just filed to add another $4.5 billion plant. Those bees add up. And somewhere, I think Sam's been absolutely right. This is a new cycle. We never had situations in the other times we had bear markets where we also had $6.5 trillion added. It's in the trickle down world, because every dollar you spend on that plant, there's about $12 that goes into the economy with jobs and carry on and insurance and all that stuff. And so we're in essentially an infrastructure bull market, and we haven't had an infrastructure bull market, in a long time. And it's out there with basically free money. I just ordered an electronic EV, of which I get a $7,500. I leased it, a $7,500 credit that goes against the lease. I couldn't say no. I couldn't say and it's made in the United States, and it uses, EV battery metals from the United States and Canada, North America, blah, blah, blah. If you just add all this stuff out, so I did for our subscribers this week, I just added up the piles of money that have been pushed into the system, and then the recovering of work, and then the top 20% of people who are spending like crazy. It's just mathematically impossible to have a recession unless the Fed went Volcker, but the Fed is not going to go Volcker. And, if they were going to do it, those dot plots, and plus they tell Greg Ip at the Wall Street Journal, a couple of other guys that they like to, tell what they're going to do. If they were saying, hey, man, we got 4 more rate hikes, here's the dot plot, et cetera, that'd be one thing. But they're not, because it's an election year and they're not going to do it.
Toby, you love acronyms, so maybe you can add GV, going Volcker, along with EV.
I love that.
You know what? Sam, only you and I remember Paul Volcker. As I said, I was like 1981. I'm selling bonds to pension plans as the junior dude at Kidder Peabody. I'd walk in and people, would start throwing knives at me and, paper balloons and shit. And I say, you guys are all bummed out because your bonds are worth less 40%. By the way, we forgot the part about how the bond market was down 22% in 2022, which hasn't happened except for 1991 when I was trying to sell bonds. So now, we're at that situation where we don't have the physical capacity. Oh, by the way, I think we had a $282 billion national debt at that time, not $7.3 trillion. So that's another reason why the Fed can't go all Volcker, because if we raise the debt service for the United States by 2%, we'd be wiped out. The dollar would drop, bond values would soar. Yields would soar. So we're in a box, and we used to be in a box where you had to raise rates. Now we're in a box where you can't raise rates.
Yeah. Hey, Sam, I wanted something you mentioned in your commentary, how you talked about the S&P with narrow leadership. And Toby and I have been talking about this on Buy, Hold, Sell for some time, that it's really a handful of stocks that have really pushed this market higher and obviously in that melting up phase. But do you think that poses more risk for an equity investor right now, knowing that you only have a handful of companies that are pushing stocks higher?
Well, I think if you look at the S&P on a cap-weighted basis, then it's the Magnificent Seven, and it's really from communication services, consumer discretionary, and tech that are doing the driving. But if you look at it on an equally weighted basis, about 60% of the stocks in the S&P 500 are in positive territory this year. If you look also at the percent of the 153 sub-industries in the total stock market universe, that's the large cap plus mid cap plus small cap, 75% of them are currently trading above their 10-week or 50-day moving average. About 65% are above their 200-day moving average, and nearly 60% are above both. So it's not just 7. It's because these are the behemoths that are getting most of the attention. But certainly from a mid and small cap area, there's also participation. And when you look to the near 40% discount that the mid and small caps are trading on a relative PE basis, it's basically screaming for any kind of a long-term investor to hit like an eBay, buy it now.
Yeah. Hey, Todd, okay. I had this. There's a couple of research reports I just read recently that went back to every bull market. And the data said that in every bull market, it was 10% of the stocks that allocated for most of all the gains. It's not like this is unique. I think a lot of people were focusing, well, how can it be the Magnificent Seven? If you get rid of that, we're all flat. Sam made all the great points on that math. But I'm not always Mr. History, but you go back to the 60s, you go back to the 70s, you go back to the 80s, 90s. When you had this, these bear markets turn into bull markets, it was 10%. Why? Because there was new stuff that came out. The disposal companies are not going to, the horse and buggy guys are not going to be leading, the Industrial Revolution. When we had the Nifty 50, before even I started, Sam, we had 50 companies that led, basically were all the gains for 7 or 8 years. And then it pooped out the year that I made my first investment in a mutual fund, the Enterprise Fund, Sam. Jerry Tsai was a neighbor growing up. And he came by and he showed me his like commission check or something. He pulled out of his book, and he had a $125,000 payment he got for his like quarterly bonus. And I was like, I'm getting into that business. That's how I got started.
Was he in the first fund?
Yeah. He was the manager of the enterprise fund. And so anyway, my point was that if you go back in history, Todd, don't be afraid of 10% of people leading the new bull market, because our economy transitions and transforms and leadership changes. And
well, it's good. It's good to know. But we've talked about the FOMO investor and the ones that are coming in right now. And you guys know hedge fund managers, they look at the Sharpe ratio, and that's the measurement of risk. Yeah. So if you have these new people that are coming into the market, they're throwing this cash in there. That's great for the ones that have already been invested. But I wonder how much risk there is. Is it riskier now than it was, say, back in January? It sounds like it's not. It's actually, I'm not going to use the word safer, but it's clear that this is a broad-based rally, and with many more stocks than I think what's being reported right now, which is a great sign. It's a great sign for the bulls to continue to run.
It is broadening out, and even though Toby doesn't want me to say it, according to history, that basically after, in what I call a garden variety bear market, a 20 to 40% decline, after we eclipsed that plus 20% move to confirm that we're in a bull market, the S&P continued to advance for an average of 4.5 months, rising 14.5%. Obviously, not every one of those instances had that kind of return, but basically the weakest one had a gain of about 5% or so. So typically it's not like the messenger from Marathon who says, "Rejoice, we conquer," only to collapse and die out of exhaustion. We still have, we still have ways to go.
All right, and that's a historical metaphor that I can totally get behind. Todd, I would only add this to our very smart guest, that markets are at the beginning of all this are still human beings and the psychology of human beings. We've always had FOMO. We just didn't have a good acronym for it. I mean, my Lord, did we have FOMO when Barbara Streisand was giving stock picks on the Today Show in 1998.
Barbara Streisand.
Yeah, she was. I remember watching that, and I didn't even have a video recorder. I was just so dumbfounded that Barbara Streisand was telling people to buy eBay and something else. Anyway,
it was being a funny girl.
Yeah, right. Being I'll be here all week. But Sam is so right about. I mean, I just use the psychological perspective on it. Is that as soon as people get down and fearful, they sell. That's always the retail. That's why MLPs, for instance, master limited partnerships, during the beginning of the pandemic, a master limited partnership that has 20-year contracts to deliver natural gas or oil or water through these pipelines with the largest companies in the world that have never had default, but they're owned by individuals, not pensions, because they have a K1, right? You can't do that as a pension. They dropped 80%, some of them, for absolutely no reason, except for a not FOMO. It's get me the FOMO out of here, because they were just, they didn't know.
Yeah, it's not FOMO, it's oh no.
It's oh no, right? And we thought, I just got a note from a subscriber today, a management client too. He says, Toby, I'm up 420% on these MLPs that we bought for $2 on the dollar, plus my yield is like 30%. And I said, well, that's great, Mark, but I know you're 75 years old. That's never going to happen again to you, my friend. So don't sell any of that stuff. Keep getting those reinvested dividends if you want. You don't need the money. But we've had these way historic, way over the top, back to back to back. And I think what Sam is saying and what I'm saying is that now that we're sort of through the darkest part of the tunnel and you could actually see some light, now the psychology is following history, and people are saying, listen, I still have 25% of our funds getting 6% yields, from treasuries. That's just a ballast thing. But, we're now at that point where businesses are going to grow. Earnings per share, people are so afraid they were just going to fall off the cliff, and that's not happening. So the fundamentals are right, and there's a lot of cash on the sidelines, and where's it going to go now? That's really the answer.
Well, they're going to start investing in pets.ai, AI, I guess, right? So,
yeah. Right. No.
Let's hope that doesn't. Please don't do that. We're not doing it. Not even saying that even exists.
I'll bring up my puppet. I'll bring up my puppet if you want next time.
I haven't seen the puppet in over a year. I thought you lost it, so you got to bring it back. Got to bring it back. So listen, Sam, one more time. What is the price target? What do you have on the level for the S&P? 45,
45, 75, and
45, 75.
Yep, and 48.20 by this time next year.
48.20 this time next year. That sounds like a buy, hold, sell exclusive to me. So that's awesome. We'll hold you to that. But
Todd, my target is 48.30 next year.
It's like
yeah, if you go over, you don't get the washer and dryer.
Yeah, exactly.
There you go. There you go. So we're going to close out the show on that one. So listen, on behalf of Tobin Smith, I am Todd Schoenberger. We want to give a special thanks to Sam Stovall. He is the Chief Investment Strategist over at CFRA Research. Go check out CFRAResearch.com for all of his commentary. I'm sure Sam obviously is they publicize you just as much as we're going to publicize you. So we do appreciate you being on the show today, Sam. And I can't thank you enough for that. Definitely. So listen, so thanks again, ladies and gentlemen, for joining us on Buy, Hold, Sell. We'll catch you next time. Take care.
Financial News TV, just the way you like it. Fast-paced, unadulterated, in-your-face, rock and roll style. Join us next time on Buy, Hold, Sell Live.
Oh, yeah, I'm going to remember all that. I can't even remember. Oh, God. Yeah, well, that doesn't. I want you to, oh, my God. Fast pace, no, oh, sorry.
Take one.
Fast pace, no holds barred, in your face, rock and roll style.
Woohoo!
Good sign.
Let's kick some